Welcome. This is our first lecture in topic 3, which discusses the presentation of the balance sheet and disclosure notes associated with the annual report. Before we can look at how we're going to put together a balance sheet, it's important that we understand how the users are going to take the information we present to them and use them. This will allow us to tailor the format of our balance sheet to meet the needs of the user. And in financial accounting, we are there to serve the user. The balance sheet has certain limitations. Users want to know the market value of a company. The balance sheet, because it is based on GAAP, and GAAP, for the most part, uses historical cost, does not try to portray the true value of a firm. In finance, the value of a firm is established by taking the number of common shares that are outstanding and multiplying them by the price per share. Well, if you were to do that for any company and compare it to its accounting balance sheet, those would not match. In addition to the valuation that is used, the historical cost for the most part, there are certain other valuable resources that are not considered economic resources. These are things like the reputation of the company. If you are a soda drinker, you will probably fall into one of two camps, a Coke fan or a Pepsi fan. Well, the company's ability to build their reputation and to have their products differentiated in the market is a valuable resource, but it cannot be measured for accounting terms. There are many other things, such as the skills of our employees, the ability of our research and technology. This is not to say that the balance sheet is totally useless. Presenting information in a relevant and reliable manner that can be compared year to year and is consistently presented allows the users to do three things with the balance sheet. They can predict future cash flows. They can make decisions about the liquidity of a business, its ability to pay current obligations, and its long-term solvency, the ability to pay its interest and debt responsibility in the long term. Of course, failure to do that would force a company into bankruptcy. All right, so the first things that users need is comparative data. 1 year's worth of financial information does not allow for a financial analysis. So users have to compare year-to-year financial positions. So we would look at a company over a period of time. Balance sheets and annual reports of public companies typically present 2 years' worth of information on the face of the balance sheet, and enclosed in the annual report is a chart that has key financial information such as total current assets, total current liabilities, retained earnings, paid in capital, net income, etc. And that information will be available in a chart that can have up to 10 years worth of information, so that users can spot trends and make predictions on future cash flows. In horizontal analysis, we look at the trend from year to year. Horizontal analysis can be done over a 2-year period, up to any number that the user wants. We will take a look at an example and discuss how horizontal analysis is done. But basically, we express changes in each element of the balance sheet as a percentage of the change as a percentage of a base amount from a previous year. Or the previous year becomes the base amount, I should say. In vertical analysis, we take one number on a financial statement. In the case of the balance sheet, the element that we're going to use typically is total assets. And we would express each of the elements of the balance sheet as a percentage of total assets. And this is for the 1 year period. You would then be able to spot changes in the makeup of the balance sheet that would allow you to spot trends that would be useful in making decisions. Ratio analysis is very useful, not only from year to year for the same company, but comparing a company to a competitor that is of a different size. Ratio analysis allows us to compare two unlike size companies side by side. This is an example of a vertical analysis of financial information. Here we see each element of the financial statement presented as a percentage of total assets. And we can see the change from year to year. In year one, cash was 3.7%. In the next year, it has grown to 3.9%. You can see that for the total current assets, the percentage is up. And that would be a positive trend. We see retained earnings is growing. We see total liabilities are reducing. Let's take a look at how we calculate horizontal analysis. In horizontal analysis, we're measuring the percentage change from a base year, which is always the earliest year. So in this example, we have 2010, and we want to measure the change in cash from 2010 to 2011. The formula for this is going to be in Excel, opening the formula with the equal sign. We need first to do a subtraction, so we're going to put parentheses so the program does that function first. We're going to take the current year, subtract the base year, then divide by the base year. So the formula is the current year minus the base year, taking that amount and then dividing it by the base year. And when we do that, we see that there has been a reduction in cash, as we can see here, and it is down 40%. Well, if we're doing this for a full balance sheet, it becomes very easy then to take this, cut this, paste this. If we have a year where there was, as in this case, no intangible assets 1 year, and it's grown, well, that answer is not going to be mathematically possible. Can't divide by 0. You would get that error message in Excel, and then you would simply type in NA for that instance. As you can see here, while cash is way down, before we go off and say that this company is having trouble, we should notice that they had a particularly good year, and they had a very large increase in retained earnings. So again, we express each change for each element of the balance sheet This allows for trend analysis. 2 years is good. As you would imagine, a 5 or 10-year analysis would be even better. This is our vertical analysis that we looked at before, but let's see how we determine that percentage, the makeup of cash as a percentage of total assets. So to do that, we take the cash amount and we divide it by total assets. In Excel, if we want to lock in total assets that will allow us then to copy and paste this formula, we have to take an extra step. In order to lock in the total asset amount, we either type in the total asset amount of 391,000, or we highlight that cell and put a $ in front of the column B, a $ in front of the row 33. That will allow us to copy and paste our entry down, leaving this cell as the cell that will be divided by the cell to its left. And we'll do the same thing for 2010. We'll take the cash amount divided by the total assets. If you hit the F4 key after highlighting the total assets, that will automatically put in the $ and lock in that cell. So this is a little Excel trick. If you were to simply copy and paste, as Excel moved down each row, it would take the number to the left and divide it by the next row down. So if you don't do the locking in, you're not going to get a correct answer if you copy and paste. And of course, we want to copy and paste because speed is a good thing. We spoke about liquidity ratios, and there are two that users rely on. The first is the current ratio, which measures the company's ability to meet its short-term obligations. And users will take the current assets and divide it by current liabilities. In the classified balance sheet format, we provide users with these subtotals. We give them the total current assets, total current liabilities, because we know they are going to want to do this ratio. The other ratio is a more stricter or more, I guess stringent is a good word, which is known as either the quick ratio or the acid test ratio. Quick assets are cash, marketable securities, and accounts receivable. Current assets such as inventory are not generally considered a quick asset. However, big retailers had the ability to quickly convert inventory into cash by having a little thing called a sale. So it is possible for some analysis, because again, each user is in charge of their own analysis, that some financial analysts would include inventory or a percentage of inventory in determining this quick ratio. Others may not. Our solvency ratios are the debt to equity ratio, which is simply the total liabilities divided by shareholders' equity. And this gives you the percentage or the relationship between debt and equity. The other is the times interest earned ratio, which is a margin of safety. Debt to equity measures the risk in the cash flow relating to the repayment of the principal amount of the debt. The times interest earned ratio is a margin of safety as to the cash flow that relates to the payment of interest. in the times interest earned ratio, we take net income and we add back two numbers off of the income statement: interest expense and taxes. Because both of these occur after the payment of interest. So the amount of earnings that are available to pay interest, you add back the interest expense, because that would be double accounting. And since interest is deductible for taxes, analysts add that back. And the number you get here tells you for every dollar in earnings before interest and taxes, compared to the interest. So for every dollar in interest expense, this will give you the number of dollars of earnings. Now that we have a general idea of how the users are going to use this information, we can start looking at how we're going to format our balance sheet.